This conference will now be recorded.
Hello and welcome everyone. My name is Yasir Gulfraz. I'm your tutor today for UK taxation for businesses. How's everyone? Everyone is fine. How are
Yeah,
you,
good.
Nizar and everyone? Can
I'm
you
okay.
hear my
Thank you.
voice and can you see my screen?
Yeah.
All right, okay. So today we will discuss about in this identification of key advice that is required to supply on the taxes applicable in specific situation. Then different ways of achieving personal or business taxation outcomes, learning to different tax consequences. Then assessment how assessment of how taxation affects financial decisions of both incorporated and unincorporated businesses. Assessment of how taxation affect advantages and disadvantages of different courses of action, and understanding of statutory obligations imposed in a set scenario. So when uh, indicative contact, when we faced any here, when faced with a specific tax situation, it is important to obtain advice on the relevant taxes that are applicable. So this includes identifying any income tax, capital gain tax, GST, or other taxes that may be applicable and the potential implications of these taxes. So when making financial decisions, individuals must assess the impact of taxations on the outcomes. So this involves understanding the different types of taxes that may be applicable and the potential implications of these taxes on the overall financial decisions. When considering different courses of action, what he's talking about, the advantages and disadvantages of different courses. So uh, it is important to understand the advantages and disadvantages of each option in term of taxation. This involves assessing the potential tax implications of the different courses of action and the potential benefit of drawbacks of those options. So here, including corporation tax to include the scope of corporation tax, taxable total profit, chargeable gain of companies, comprehensive computation of the corporation tax liability, effect of group corporate structure, use of exemptions and reliefs in deferring and minimizing corporation tax liabilities. So corporation tax, this is tax is a tax imposed on the taxable profit of companies and other organizations, like including clubs, societies, associations, and other unincorporated bodies. Stamp taxes or stamp duties to include scope of stamp taxes, liabilities arising on transfers, use of exemptions and relief in deferring and minimizing stamp taxes. So then is a value-added tax. Stamp taxes are taxes on certain transactions, such as the sale of property on share, as we discussed previously. So next one is a VAT, value-added tax, to include scope of VAT, VAT registration requirements, VAT rates, cash and accrual system of accounting for VAT, computation of VAT liabilities, and completion of VAT returns, special scheme for accounting returns. So you got it, three type of taxes.
Yeah. Yeah.
Any questions so far?
No.
Okay, so here is a calculation of income tax basic rates. As you know that this, we discussed previously as well, what is basic rate up to 37,500 pound. 20%, then dividend rate 7.5%, higher rate above 37,500 up to 150,000 is it's a 40,000, and then over 150,000 is 45%. Dividend rate would be 38%. Uh, then starting rate of 0% applies to saving income where it falls within the first 5,000 of taxable incomes. So personal allowance, 12,500 pound, transferable amount 1250, income limit 100,000 pound, whereas just net income is 125,000 or more, the personal allowance is reduced. So days in UK, if resident status is automatically not resident, okay, not previously resident, 16 to 45 days, 46 to 90 days, resident if three UK ties, you know, and then 183 or more automatically resident. So child benefit income tax charge, where income is between 50,000 and 60,000, the charge is 1% of the amount of child benefit received for every 100 pound of amount over 50,000. A car benefit percentage, he's repeating, that previous things again, a relevant base level of emission 95 gram per kilometer, 50 gram per kilometer or less 60%, then 19% above 751, up to 75 grams, then 76% uh, to 76 grams to 94 grams per kilometer, 22%, 95 grams per kilometer would be 23%. So car fuel benefit, calculating the car fuel benefit is 24,100 pound. Company wine benefits, uh, individual saving account and property income basic rate restrictions applies to 75% of finance cost relating to residential property. Then again, pension scheme calculation is about annual allowance, minimum allowance, income limit, maximum contribution which can qualify for tax relief without any earning is 3,600 pound. Approved mileage allowance cars 45p per miles up to 110,000, and then 25p per miles after 10,000. Capital allowance, uh, plant machinery, any assets 18% and then special rate pool 6%. New car 100% with emission, then between 51 and 110 gram would be 18%, then over 110% will be 6%. So he is again talking about cash basis account revenue limit 150,000, cap on income tax relief, no, at higher of 50,000 or 25% of income. Corporation tax, year 2019, 2018, and 2017 was 19%. Profit threshold 150,000 pound. VAT again is 20%. Registration limit 85,000, or deregistration limit is 83,000 pound. Inheritance tax rate is, as we discussed, 325,000 pound. 100 and residence nil rate band is 150,000 pound. Rate of tax on excess over nil rate band, lifetime rate 20%, and death rate will be
Mhm.
40%.
Yeah.
Here is talking about capital gain tax. We discuss different classes. Lower rate is 18%, normal 10%, residential property 18%, then annual exempt amount 20%, 28%, entrepreneurs relief and investor relief 100 and 12,000 pound, lifetime limit 100,000 pound, rate of tax 10%. National insurance contribution NIC class 1, class 2, class 1, class 1A, class 2, and class 4. So 1 pound till 806,000 1032, and then over till 50,000 pound will be 12%, above 50,000 2%, and again class A employer. First one is about employer, second one is about employer. Okay, and
Mm-hmm.
30.10 class 1A is a 13.8%, class 2 £3 per week small profit threshold. Uh, Class 4 is up to 8,632 pounds, 32 pound will be nil, above 8,633 till 50,000 per year will be 9%, above 50,000 pound and above per year 2%. So rate of interest, official rate of interest on underpaid tax, rate of interest on overpaid tax, 0.50%, 3.25% underpaid tax, and 0.50% will be overpaid. Standard penalties for errors, uh, deliberaties and concealed, deliberaties but not concealed or careless, uh, 15% to 100% in different situations, like maximum penalty, minimum penalty, unpromoted prompted disclosure, or minimum penalty prompted disclosure. So calculating tax, uh, can you hear me, Nazar?
Yeah, yeah, yeah.
Everybody can hear me? Okay. So calculating income tax components, uh, trial income, net income, taxable income. So non-saving dividends, total of all components, net income, total income less losses, taxable income, net income less personal loss. So tax rates, non-saving basic rate band, again up to 37,500 is 20%, above 37,500 pound is 40%, which goes up to 150,000 pound, and then over 150,000 will be 45%. Uh, they For the tax year 2021, Joe has a salary of 46,500 pounds, saving income of 2,000, and dividend income of 6,000 pounds. So during the year of period, interest of 300 pounds, which was for a qualifying purpose, Joe employees deducted 6,800 pounds in paying from his earning. This income tax payable, the Joe is here. He's this is a activity for that one of employee named Joe, and his calculations: income 46,000 pound, saving income 2,000 pound, dividend income 6,000 pound. So altogether is 54,500 pound, interest paid 300 pound, personal allowance 12,500 pound, and
Mm-hmm.
then taxable income is 33,700 pound, 2,000 saving income, and 41,700 pound. So
Mm-hmm.
income tax payable about 1550. So here is a higher rate taxable. So his saving income nil rate based is 500 pound. So when we will calculate, dividend nil rate band uses up to remaining basic rates of 1800. So that's up to 37,000 pound minus 33,700 minus 500 minus 1,500 pound. So saving income and dividend nil rate band will mean that taxpayers do not have any tax liabilities in respect of saving and dividend income, because there is a nil tax rate.
Mm-hmm.
Uh, yeah. Next is 2.2, analysis tax advantages and disadvantages of different course of actions. So here there are basically there are several tax planning strategies that uh, we will discuss over here. So Donald and Theresa are a married couple and have regular annual income as follows. Donald's salary is a 60,000 per annum, Theresa's salary 18,000 pound per annum, interest 2,000, dividends 9,000. So it is clear from the above information that Donald is a higher rate tax payable with taxable income of 47,500 pound. So 60,000 minus 12,500, which is basic, allowance, and THESA is a basic rate taxpayer with taxable income of 16,500, 18,000 plus 200 plus 900 minus 12,500. So in this situation, it would normally be the case that for tax planning purpose, it would be advisable to see if any investment income could be moved from higher rate taxpayers to the basic rate taxable. So there are several, that tax here, the income is being taxed on 20% Theresa, as she has saving income in excess of her nil rate band of £1,000. So there are several tax planning strategies that Donald and Theresa can use to move investment income from Donald. So higher rate taxpayer to Theresa basic rates taxpayer. So in order to reduce their overall tax liability, one such strategy is to transfer income producing assets such as stock or shares, and from Donald name to Theresa name. So this can, because that as we discussed, married couple tax situations. So this can help to reduce the amount of income tax that Donald has to pay on his investment income, as well as potentially lowering his liability for capital gain tax if the assets are sold at a later date. So another strategy is to make use of tax efficient investment vehicles such as individual saving account or pensions. So by investing in these vehicles, Donald and Trisha can shelter their investment income from tax, potentially allowing them to keep more or their investment returns. There is a £2,000 minus 1,000 is equal to £1,000 multiplied by 20% is equal to £200. So there may be also consider charging the way in which they receive their income. For example, if Donald has the option of taking a bonus or a salary increase, he may choose to take it in the form of a tax efficient benefit, such as a company car, private healthcare. So rather than as additional income, this can help to reduce the taxable income and potentially lower this his overall tax liability. So that Donald and Theresa can use various tax planning strategies to reduce their overall tax liability, and to take advantage of the nil rate band, they can transfer £500 of interest uh, income to Donald, so that he can use the saving income nil rate band of £500, which is currently not being utilized. So this transfer would reduce Trisha taxable saving income by £500, resulting in a tax saving of £100, 20% of £500. Second strategy is, the second transfer would be a sufficient share of moving. So is to, enough shares is to transfer, that enough shares to move £2,000 and dividend income from Trisha to Donald, so that both can use their dividend income nil rate bands of up to £2,000. So this transfer would result in a tax saving of 320%. Is not here, I think so, but 20% of £2,000 on their dividend income. So here they can, that 320% would be 20% over here as a dividend income. Failing rate. Assess the statutory obligations imposed in a given situation, including the application of non-compliance. So failing date. Uh, if an individual wishes to file, their tax return using a paper form, have you done ever paper form tax return? Might be a few years back.
Well, yeah, I mean, I've done one recently. Um,
Yeah,
well, it's just a self-assessment.
okay. Because that still some people wants paper assessment. They don't want computerized things like that. I know a couple of people, they always ask for a paper return, or
Yeah.
that things like that, what everything on the papers.
Hmm.
A tax return using a paper form, the filing due date depends on the circumstances. If the notice to file a return was issued after the end of the tax year, the deadline for paper filling is 3 months after the notice was issued. Otherwise, the deadline for paper filing in the 31st of October following the end of the tax year. So is the same if an individual files their tax return late, there are penalties they may face.
Yeah.
So yeah, so the initial penalty of late filing is £100, and if the tax return is more than 3 months late, the individual may be charged on additional penalty of £10 per day for uh, next 90 days. So if the return is more than 6 months late, the individual may face a penalty of £300 or 5% of the tax due, whichever is higher. If the return is more than 12 months late, the individual may face a penalty of 100% of the tax due.
Hmm. Yeah.
So have you got any client like this? Any situation, any issues?
Not just one client I had a late return.
Okay,
Yeah, and he had a bit of charges. So.
okay. So returns, penalties for error may be imposed if the returns inaccurate due to carelessness,
Hmm.
deliberate error without arrangements to conceal, or deliberate error with arrangement to conceal. So the amount of the penalty depends on the level of the potential lost revenue, which is PLR, potential lost revenue.
Hmm.
So which is here is a lost revenue, for example, tax unpaid. So which is the tax that was unpaid as a result of the error. Penalties can be reduced if the error is voluntarily disclosed to HMRC. The maximum penalty is equal to the PLR, uh, and the minimum penalty is also equal to the PLR. For up unpromoted, unprompted disclosure, the penalty is 0%. For prompted disclosure, the penalty is 15%. And if the error is due to carelessness, the penalty is 30%. If prompted, uh, of or 0% if unprompted. If the error is deliberate but not concealed, the penalty is 20%. If prompted, or 0%
Hmm.
if unprompted. uh, if the error is deliberate and concealed, the penalty is 100%, and if prompted, or 30 to 50% if unprompted. So here next is penalties for late notification imposed if does not notify chargeability by 5th of October following end of tax years. Amount of penalty. Basically, penalties are imposed by for errors and late notifications in tax returns. The amount of the penalty depends on the type of error and whether it was disclosed to HMRC voluntarily or not. So penalties are for errors are imposed if the return is inaccurate due to carelessness, deliberate error, but not arrangement to conceal. Uh, Prompted disclosure of 15% for careless error, and 35% of deliberate is error. The penalty of deliberate errors which arranged to conceal is 100% of PLR.
Hmm.
And then unprompted disclosure, 0% for less than 12 months, 10% of for uh, more than 10% for more than 12 months, and then 20% for less than 12 months, 35% for more than 10 months. So records here. Records must in journal be kept until the later for 5 years uh, after 31st January. Basically, in journal, individual must keep their record tax record until the later of two dates. If the taxpayer is in business or has rental income, they must keep their record for 5 years after the 31st of January, following the relevant year. Otherwise, they must keep the record of 1 year after the 31st of January following the relevant tax year. A failure to keep adequate tax records could result in a penalty of £3,000 uh, for each tax year concerned.
Hmm.
So it is important for individual to keep accurate and up-to-date record to avoid penalties and ensure compliance with tax regulations. Next is payment of tax.
Hmm.
Uh, Payment of tax. Individuals are required to make payments on account. So towards their income tax liability on two dates, 31st July July and 31st of July during the next year. The final payment of income tax is due on the 31st of January following the next year. So the amount of each POA payment on account is calculated as 50% the previous tax year's income tax liability less any tax that was paid at source. So if the income tax payable for the previous year falls below 1,000 pound or it more than 80% of prior year liability met source.
Hmm.
So then no payment on accounts are required. In some cases, an individual may claim to reduce their payment on accounts to a specific amounts or to nil. So uh, here, it is very important to individual to keep track of their tax liabilities and make timely payments to avoid penalties or any interest charges. Uh, any questions so far, Nizar? Anyone? These
No.
are basic things anyway. Income tax.
Yeah.
Okay. So, yeah, interest and late payment of tax. So, late payment of tax penalties are levied on late payment of final payment of income tax class 4 national insurance or CGT was as follow paid penalties. Class 4 national insurance contribution or CGT capital gain tax, if the payment is made no more than 5 months after the penalty date, a penalty of 5% of the unpaid tax is charged. If the payment is made more than 5 months but no more than 11 months after the penalty date, the penalty is increased to 10% of the unpaid tax. If the payment is made more than 11 months after the penalty date, the penalty is further increased to 15% of the unpaid tax. The penalty date is 30 days after the due date for the tax. In addition to penalties, interest is charged on the outstanding amount of tax. Interest is charged on payment on accounts from the normal due dates, which are 31st of January and 31st of July. So interest is also 31st of January and 31st of July and 31st July, 31st January and 31st July. Uh, so the rate of interest is currently 10% per annum. It is important to individual uh, to make timely their tax liabilities to avoid penalties and interest charges. Non-compliance with relevant laws. Here, non-compliance may result in fines, legislations, or other consequences for the client that may have a material effect on its financial statements. So basically, non-compliance with relevant laws and regulations by a client may result in penalties, legal actions, or other consequences that could have a significant impact on their financial statement. So it is also important to note that non-compliance could also have broader implications for the public interest, particularly if the cause substantial harm to investor, creditors, employers, or the general publics. So, if a professional accountant becomes aware of matters that are clearly inconsequential in nature and have no significant impact on the client, their stakeholder, or the general public, then they are not required to comply with this section in regards to those matters. Next one is assess the effect on taxation of financial decisions made by individuals and businesses. Your business may become affected by sector taxes, which means it is important to ensure you are complying with any sector tax obligations. So, as well as this, there may also be opportunities to reduce your tax costs. In this post, we will look at how taxations can affect your businesses. So it is essential for businesses to be aware of sector-specific taxes that may impact them and to ensure that they are compliant with any relevant tax obligations. By doing so, they can avoid penalties and other negative consequences. In addition to meeting their tax obligations, businesses could also consider opportunities to minimize their tax cost. As an employer, taxes and national insurance contributions are deducted directly from your monthly salary, leaving you with the net income. So, as a business owner, it is your responsibility to ensure that you pay the correct amount tax.
Hmm.
Here is talk about. Sorry,
No, no, I'm listening.
did you ask anything, Nizar?
No, no, no.
Yeah. Okay. All right. Okay. As a business owner, I hope you know very well that it is a business owner responsibility to ensure that uh, pay the correct amount of tax on your business profit and make any necessary national insurance contributions. It is important to stay up to date with tax laws that may affect uh, their business and seek professional advice if necessary to ensure compliance and maximize tax efficiency. Corporate tax, also known as a business tax, is a tax is a charge on the profit a company makes. Corporation tax is a similar to income tax, but for companies, meaning that as soon as your business starts making a profit, it needs to start paying corporation tax at the correct date. So it is important for business to pay their taxes correctly, as non-compliance can lead to penalties and other consequences. Business taxations can impact company cost, as an increase in corporation tax can have the same effect as a rise in expenses. This can result in higher prices within the business. Other types of businesses taxes, including environmental taxes such as a landfill tax and value added tax. Annual accounting scheme. Uh, Annual accounting scheme is an option for business whose taxable turnover does not exceed 135,000 pounds, excluding VAT. So annual VAT return due 2 months after the year end, payments of VAT needed during year. So uh, by joining this scheme, businesses can submit only one VAT return per year. due 2 months after the year end and make payments of VAT throughout most of the year rather than monthly. So if a business taxable turnover exceeds £160,000, which is here, uh, in the previous 12 months, it must leave the scheme. The payments of VAT due during months 4 to 12 are calculated based on 110 previously
Um, yes, sir.
To use the scheme, a business must be to ensure that the turnover limit is not. Yes.
Sorry, you're breaking up a lot.
Yeah,
Um,
can you hear me?
I can, but there's a lot of kind of you've got a bad reception or coverage, I think, or bad connection.
Can you hear me now?
I can hear you, yeah, but then earlier, it wasn't clear.
Sorry, there was some
You were
connection
fading
problem. Yeah,
away. Okay,
I know it was. Sorry about that. It was. I think so. There was some connection problem.
no worries.
So, uh, where is it
Okay,
gone?
so we're talking about the VAT scheme. If they reach 1.6, then
Yeah,
they need to leave the scheme. Yeah,
yeah. We were here. We were talking about annual accounting scheme.
yeah.
Okay, VAT scheme. Uh, cash accounting scheme account for VAT on basis a cash paid received annual taxable turnover must not exceed £135,000 and
Mhm.
to join all VAT returns payments must be up to date may also be able to use annual accounting scheme. So cash counting scheme is an option for businesses to account for VAT based on cash received and paid to be eligible. The annual taxable turnover must not exceed 100 and, again £135,000, which is excluding VAT, and all VAT returns payment must be up to a date. So this scheme may also be used in conjunction with the annual accounting scheme. So, one benefit of the cash accounting scheme is that it is useful when a long period of credit is given to customers as it allows for automatic bad debts relief. So, this means that the output VAT will never need to be paid over to HMRC on bad debts. So, a disadvantages of the scheme is that it is less beneficial, where long periods of credit received from suppliers. It is very important to note that a business must leave the cash accounting scheme if it is taxable turnover for the previous 12 months exceed £160,000 excluding VAT. Flat rate scheme. Any idea about flat rate scheme?
No, no.
Okay. Business can calculate VAT due by applying a flat rate percentage of VAT inclusive taxable turnover. So flat rate scheme is an option for businesses to simplify their VAT calculation. Under this scheme, VAT is due calculated by applying a flat rate percentage to the business VAT inclusive taxable turnover. So this scheme is available for businesses with annual taxable turnover included a VAT of no more than £150,000. Additionally, business may also be able to use the annual accounting scheme same time. So one of the advantage of the flat rate scheme is that it is simplifies administration since businesses do not need to deal with VAT on purchase invoices. So it can lead to less VAT payable and businesses receives a discount of 1% in the first year of registration. There are also some disadvantages to consider. Business must leave the scheme of their total turnover exceed 230 pound, including VAT. Additionally, businesses cannot reclaim VAT on purchases and expenses, and the flat rate is applied to all turnover, including zero rate and exempt supplies. As a result, businesses may end up more VAT under this scheme. Yes, any question?
On that flat rate, so we're saying the advantages is not to deal with purchase invoices, as in the VAT on purchase invoices. Um, so the purchase invoice here, just to be clear, is as what the company has purchased and paid VAT to their suppliers.
Yes. So VAT on purchase can lead to basically, that you don't need to deal with the VAT on purchase invoices. You know,
Right. Okay.
I mean that there's no, if how can I explain you? Because you don't need to, handle VAT on purchase invoices. You don't need to. You have nothing to do with VAT on purchase invoices. That's a simple thing. This is out of question. So uh, but there is a disadvantage. Then you can't deal with, you can't that VAT purchases you can't reclaim. That people normally, that taxations,
Exactly. Yeah.
they reclaim their tax,
Yeah.
so expenses, so you can't reclaim anything like that.
Yeah. Yeah. That's what. Okay. Anyway, that's just a bit. Yeah. No worries. I was just thinking it's pointless, but anyway.
Which one is it?
No. 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 Sorry. Carry on. I don't want to stop you. That's fine.
Okay. Evaluate how alternative ways of achieving personal and business outcomes may lead to different tax consequences. Company must returns and inquiries. Companies are required to file their corporation tax return online, and it should be done by the filing due date, which is typically 12 months after the end of the period of account. So failure to file the return on time may result in penalties similar to those imposed on individuals. Additionally, errors in the return may also attract similar penalties as those for individuals. So, if a notice is issued on inquiry into the return, it must be given within 12 months after the later of the actual filing date. If the return was filed on or before the filing due date, or the 31st of January, 30th of April, 31st July, or 31st October, uh, immediately following the actual filing date, if the filed filing date, if the filing due date, record must be kept for at least 6 years from the end of the relevant accounting period. So any question about
No. That's okay.
okay, so next is payment of tax. Companies are, due dates. Large companies must pay their corporation tax in installments. Other companies must pay their CT 9 months and one day after the end of the accounting periods. So companies are required to pay their corporation tax within certain due dates, with large companies having to pay in installments. For other companies, the payment is due 9 months and one day after the end of the accounting period.
Hmm.
Installment for a 12 months accounting period are due in month 7 and 10th of the periods, as well as months 1 and 4 of the following period, with payment due of the 14th day of the relevant month. If a company has, that if a company's augmented profit exceeding the upper limit of 150,000 pound, here if it's above 150,000 pounds, they are subject to quarterly installment.
It's
So, sorry, yeah,
no, sorry, it's 1.5 million.
yeah, 1.5 million, 150,000 pounds,
Okay. Oh
15,000,
yeah,
15,000 pounds,
yeah,
yeah.
yeah, yeah. Yeah. So
So, and any, did I say wrong anything here?
no, no, no,
150,000.
no, no. I thought you said 150,000. I just completely Sorry, sorry,
No.
sorry.
So ignore dividends from related 51% and interest runs from the due date. Interest paid is a tax deductible expenses or companies.
Okay.
So here basically 51% group companies interest on the payment of corporation tax runs from the due date, and the interest paid is a taxable deductible expense for companies. Upper limit, and the upper limit is multiplied by months, 12 for short accounting periods, divided by the number of related 51% group companies in the group companies under common control. Example, here he is giving a short example. A company which has one related 51% group company prepares accounts for the 9 months of to 31st 3/16 March. The upper limit for this period is 9 multiplied by 100, 1.5 million divided by 2 is equal to 562,000 pound 500. Okay, this is a basic calculations.
Yeah.
So research and development. Small medium sized enterprise less than 500 employees. Here a business, if a business is classified as a small or medium sized enterprise with less than 500 employees and a turnover of the 100 million pound, or a balance sheet of less than 85 million pound, it may be eligible for research and development relief. This relief, basically allows for a 230%. uh, is there mention here or not? Here 230% deduction of qualifying research and development expenditure, which includes spending on research and development staff, consumable and transformable materials, computer software, power, water, and fuel. Okay, and if the research and development relief creates or increase a loss, the loss can be surrendered for a research and development tax credit at a rate of 14.5%, which is capped at the business's pay or national insurance liability. IR 31.5. Any idea about Nizar? IR, it's a very common thing. Can you hear me? Hello? Can you hear me, Nizar?
Yeah. Sorry, sorry. I can hear you now.
Yeah. Any idea about? I was talking IR 35. Can you see my screen as well now clearly?
Yeah. It's just
Sorry
I can't.
about that.
It's just.
I know.
It's just.
I know. I've got little bit internet issues because I'm away from UK.
Oh, I
So
see. Okay.
yeah. So IR 35 is a tax legislation. Basically, in simple words, a tax legislation that applies to individuals who provide their services through an intermediary company, such as a personal services company. Relationship between the worker and the client is assessed to determine if it is one of employment. It is if it is deemed to be an employment relationship, the worker is subject to tax on their deemed employment income. The employer is responsible for paying the worker's salary and employer national insurance contribution, while the worker receives payment from the client with no national insurance contribution deduction. The intermediary company may pay a dividend to the workers.
Mhm.
Have you got it? Any questions?
No, that's fine. That's okay.
Okay. Can you hear me properly now?
I
There's
can,
no
yeah.
issue. Okay. Yeah. So when it again will be continued returns and inquiries, when it comes to the filling their company tax return, companies are required to do so online by the due date, which is typically the later of 12 months after the end of the period of account, or 3 months after a notice requiring the return was issued. If a notice to inquiry into a return is necessary, it must be given within 12 months after the actual filing date. If filed one or before the filing due date, or the 31st of January, 31st of April, July, October, following the actual filing date, uh, like individuals, late filing of the returns may incur penalties as well as error. So, in term of record keeping, records are typically required to be kept for 6 years from the end of the relevant accounting period. Here, record must generally be kept for 6 years from the end of the accounting relevant basis. So, next one is basis period rules. Uh, Basis period rules apply to three scenarios: commencement of trade, ongoing businesses, and cessation of trade. So, in the case of commencement of trade, the basis period is assessed using the opening year rules and is based on the 12 months uh, accounting period ending in the tax years. For ongoing businesses, the business period is assessed on the accounting period ending in the tax year. And for cessation of trade, the basis period is assessed using the closing year rules. Opening year rules. First tax year, uh, opening year rules. Year is in which business commence trade assessed on profit from date of commencement to following 5th of April. Second tax year. Uh, Here opening rules year. So in the second year, the profit are assessed based on whether there is an accounting period ending in the tax year and whether it is 12 months long. So if there is a 12 months accounting period, the profits are assessed on a normal current year basis. If there is no if there is no 12 months accounting period, the profits are assessed on actual basis from 6th of April uh, to 6th of April to 5th of April. So if the accounting period is longer than 12 months, the period of those 12 months are assessed. If the accounting period is less than 12 months, the
Mhm.
profit of the first 12 months up to the accounting date of trade are assessed. For example, the last 12 months of a long period.
Okay.
Next is opening year rules. Third tax years. In the third tax year, the assessment is made on the 12 months ending on the accounting date in that year, which is usually the current uh, year basis. However, if the accounting period is long period, the assessment is based on the last 12 months of the that period. So overlap profit may occur when the same profits are taxed twice. So relief of for overlap profit can be obtained upon cessation of trade. In the first tax year, which is the year in which the business actually ceases to trade, the assessment is made on any profit that were not previously assessed minus any overlap profit there was assessed from commencement. Next, taxable and taxable total profit. Can you hear me, Nizar?
Yeah, yeah, I'm following.
Okay. Companies' taxable total profit are arrived at the aggregating its various source of income and chargeable gains and then deducted qualifying charitable donations. So profit of trade adjust for tax, interest from non-trading sources, any other profit and income from land and building in the UK. So pro forma of calculating taxable income, profit, taxable trading profit, interest, other income, property businesses income, chargeable gains, total profit, less qualifying charitable donations paid, and total taxable profit. Taxable total profit, interest income from non-trading sources minus interest payable on non-trading loans. So interest income from non-trading sources including in taxable total profit. So but it is reduced by any interest payable on non-trading loans. Non-trading uh, interest payable including includes loans used to buy rental properties or shares in a subsidiary. Property business income is also included in taxable total profit and treated as a single source of income calculated in the same way as trading profit. Uh, Well, although you are not expected to calculate property business income in business tax, you may be required to include it is arriving at the taxable total profit.
Yeah,
Accounting period. Companies must pay corporation tax on their taxable total profit in each accounting period. So, an accounting period must not exceed 12 months. Okay, if a period of exceeds 12 months, uh, divide profit between the accounting periods as follow: trading income time, apportion the amount before capital allowances, compute capital allowances separately for each period, interest income, property business income, and other income are gains allocated to period in which they are raised, qualifying charitable donations. Computing corporation tax payable rates of corporation tax pay. Corporation tax is computed by applying the corporation tax rate to the taxable total period. The current rate of corporation tax is 20% uh, for financial years 2016. So which runs from 1st April 2016 to 31st March 2017. So the basis period for each tax year is normally the period of account ending in that tax year. Example, a sole trader makes up accounts to 31st December each year. The basis period for 2016-17 will be the year of 31st December 2006, 2016. Opening years, there are special basis period rules in opening and closing years. So, opening year of a business, there are special rules for determining the basis periods for a tax purpose. For the third year, accounting period ends within the year. The basis period starts on the date of commencement and end of the following 5th of April. The accounting period ending in the second year is 12 months or longer. The basis period starts on the day after the end of that accounting period that end on the following 5th of April. If it is less than 12 months, the basis period starts on the date of commencement and ends on the following 5th of April. So if there is no accounting period ending in the second year, the basis period starts on the first day of the third tax year, uh, 6th of April, and ends to the on the following 5th of April. 6th of April and ends on the following 5th of April. Overlap profit. Any profit taxed twice in the opening years are called overlap profit. So overlap profit may be relieved on cessation. The focus of assessment is ensuring that the total taxable profit less losses are equal to the total actual profit. So less actual losses over the entire life of the business. Any overlap profits that were taxed twice in the opening years are deducted from the final year's profit. So these overlap profits can be relieved on cessation of the business. The profit in the final years are adjusted for tax purpose. So here is a final year profit. The final year of business basis period starts at the end of the basis period for the previous year and ends at cessation. So any profit that are taxed twice in the opening years are called overlap profit. So and they can be relieved on the cessation. The total taxable profit less losses should equal the total actual profit less actual losses. In the example here, if you see that example, Nitin says trading on 30th of September and profit for the 3 months to 30th September were 15,000 pound here, and the basis period for 2016 runs from 1st of July till 30th of September. So the assessment for 2016-17 is 76,000 pound. So overlap profit, less overlap profit of 9,000 pounds. So netted profit from year ended 30th of June worth 70,000 pound, and his profit for 3 months to 30th of September 2016 were 15,000 pound. Therefore, the total profit for the final years of trading are 85,000 pound. Uh, Overlap profit of 9,000 pounds are deducted from the final year assessment, resulting in the final trading. So profit assessment of 85,000 pound minus 9,000 pound is equal to uh, assessment is for 16 17 is 76,000 pound. uh, Change of accounting date. When a business change the accounting date, the following rules applies. Old accounting date, years of change, years of. So the year of change tax year is which the new accounting date falls. The basic period for the year before the charge runs from the end of the previous basis period to the day before the new accounting date. So the basis period for the year of change runs from the day after the old accounting date to the new accounting date. So if the gap between the end of the basis period uh, uh, for the year before the charge and the new accounting date is less than 12 months, so a new basis period is not created and there are no overlap profit. If the gap is 12 months or more, the excess period between the old and new accounting dates is taxed separately and create a new overlap period. So starting from the year before the charge, so any existing overlap profit at the start of the year of change are relieved against profits of the new basis period. So here are further reading. If you want to read, then you can go through the these ACCA websites. Any So that's it for today. Any questions so far, Nizar?
No, that's fine. Thank you.
I know that most of calculation we look at calculations a bit complicated, but I hope you are familiar with most of calculations. But it
Yeah.
is just for your knowledge. But in practical, because you are dealing with the income tax and uh, also corporation tax as well, I think so then.
Yeah, I am.
Any confusion, anything comes up in your mind?
No, I mean, it's, to be honest with you, it is not complicated. So so far, so yeah,
Yeah, no, I'm just
I
talking
don't have any
about
questions.
calculations, that when you do in practically, study is a bit, that different, but when you will do in practically, will be easy for you anyway.
Yeah,
Thank you very much. And if there is any question, drop me an email, tutor-management at ukversity.co.uk, and you also have my email as well. Okay, you got my number as well. So if you
hmm
have any question, just drop me an email or message me. So hopefully I'll see you tomorrow,
yeah,
uh, and you can start your assignment. So if there is any question regarding assignment, uh, again, you can ask me or you can drop me an email. So
fantastic.
our
So
last lesson anyway will be about assignment as well. So
okay,
thank
fantastic.
you very much and have a good day.
Thank you.
uh, I'll finish here. See you tomorrow at 11 same time.